Okay, so today's topic is going to be tax policy and administration. Should be an interesting course today if you're used to some of the more involved courses, dense courses where we do a lot of calculations and such. This might be interpreted by some as more of a fluff course. Of course, I'm a professor, so I'm in the ivory tower, so to me, I love this kind of fluffy stuff. But the policy is important in some ways, and it's important for understanding when you get down into the brass tacks and the important underlying calculations, particularly if you get in a dispute with the IRS and you have the opportunity, or what some might see as an opportunity, others as a huge headache, to go through an administrative appeal within the IRS. In those instances, sometimes it's helpful to know the tax policy and the underlying reasons for a particular tax. And so we're going to look at some of the rubrics for that and try to understand, gain a better understanding of tax policy, and then look at how that plays out in the administration of tax. And tax administration, of course, is going to be filing returns, dealing with IRS audits and litigation after. But all of that's going to be very, very light. We're going to kind of just breeze through it and try to understand, get a basic understanding of that. So let's look at our goals for today. Our first goal is to conceptualize tax policy and articulate the most common frameworks for analyzing proposed changes to the tax law. And that's really our tax policy segment, which we're going to lead off with. Number two, we want to identify the key events in the tax reporting, assessment, and collection processes, including the taxpayers and IRS's role in each of these events. Three, we want to differentiate the sources and weights of various tax authorities, which is important for purposes of understanding what type of tax position your client is in and what authorities there are that support that position, both in defense after you're already under audit, but it's also preferable to understand that prior to that point, so that when your client is preparing a tax return or even doing tax planning before the underlying economic events have occurred, then your client can understand what the authorities are that are out there and what support there is for a particular tax position, which is important. Lastly, we want to become familiar with the different instruments for completing tax research online. And we'll just cover that really briefly, talk a little bit about tax research methods, and that'll wrap up our course today on policy and administration. So to start out, I want to talk about some of the rubrics for analyzing tax policy. And this is essentially, there's kind of a combination here. So I'm combining the ways that academics and policymakers tend to talk about different tax policies and different implementations of different tax policies, and also with a little bit of an eye to how politicians do so. And so we'll talk some about the theory. We're going to talk about the practice as well, and go into some of the numbers in terms of how the federal government spends its money, and how it taxes, and discuss these different methods. And so this is helpful. It's helpful to have the theory, even though in general in our courses we don't do a ton of theory. The idea here is that understanding the underlying theories may be helpful in interpreting new tax laws as it comes out. So the overlying, and this is really just the most basic concept, is fairness. It's the idea that tax law, from a policy standpoint, should be fair to all taxpayers so that the tax law has integrity and credibility. The administration of the tax law should also be fair and impartial. So it's not just the design of the tax law, but the way it's administered. So that's the IRS's role. And so we care a lot about fairness. Now, of course, what's fair to me might be different than what's fair to you. What's fair to you is almost certainly different than what's fair to the politicians. Everyone has a different view of what's fair, but at the heart of it all, we all want, at least theoretically, a fair tax system. And that may not be true. It might be that some of us want a tax system that's more fair towards us than it is for other people. Who knows? But the idea is that pretty much everyone can agree at a basic level that we want a tax law that's fair and that's desirable. So next we look at the marginal utility, and this is another theory. The theory is that the marginal utility of a dollar to a taxpayer decreases as income increases. And so society as a whole will maximize utility by taxing lower utility dollars, by taxing higher income individuals at higher rates than low income individuals. And so the concept is pretty simple and easy enough to understand at a conceptual level and a practical level. If you have someone who has very, very low income, let's say $10,000 of income, that $10,000 in income is going to go to, at least theoretically, the support of basic needs, food, shelter, probably not very good shelter, probably not very good food, but life-sustaining activities is what that funding, at least theoretically, should be going to. Not always the case in practice, but theoretically that's what it should be going to. And so in theory, that first $10,000 that you earn, you value that extremely high. That is, how much value do you put on the money that you use to simply keep yourself alive? And so that's the first, and I would say it's probably a lot more than 10, maybe 20, 30, 50, depending on the family, of course, or how many people are being supported by that income. But the idea is that those early dollars are worth a lot. Now you can imagine somebody who makes $1 million, and we're using extreme examples, of course, here, because at the extremes it bears out really easily. On the margins, it's not always so evident that this is the case. But the idea is if you have $1 million in income a year, that next $1 or the next, let's say $5,000, for instance, is not nearly as important to you as the $5,000 that's earned after somebody who's earned $10,000. So this is the concept. And I think we can probably agree, maybe you wouldn't. But at least theoretically, it would make sense that as your income grows, the utility of that next dollar may or may not be, or under this theory, the utility of that next dollar would be less. And so since you enjoy that next dollar less, this is often used as a justification for progressive tax system. Since you enjoy that dollar less, or since you need that dollar less, then the government is justified in taxing that dollar at a higher rate than the first dollar that you earned, and at a higher rate than the 50,000th dollar earned. You would tax that 1,000,000th dollar at a much higher rate. And so that's a progressive tax system. And that, in fact, at least for income tax purposes, this is the tax system that we have, of course. We have progressive rates. They go from really 0% since you have exemptions and standard deductions. So 0% on the first 10,000 for a single individual, 10,000 and change really, all the way up to 39.6% for the high earning individuals who are earning approximately $500,000 and more. And so this concept of marginal utility of dollar, whether this is the justification for it or not, I think this is the underlying idea for a progressive tax system. And this does, in fact, whether it's based off this simple theory or not, this is, in fact, how our tax system, our federal income tax system functions for the most part. So that's the marginal utility concept. Next, you've got this concept of benefits and burdens. And the idea here is that taxpayers who share equal benefits from the government should equally share the burdens of paying for it. And alternatively, taxpayers who receive more benefits should, in theory, pay more. And so this is more or less the concept of once again, tied into the concept of fairness. People who get a lot from the government should, in fact, pay a lot. Now, this can also support a progressive tax system. I've seen this argued both ways. But it could also support a regressive. So progressive meaning that the higher income individuals are paying a higher tax on the next dollar they earn. Lower individuals are paying less tax compared to high individuals on the next dollar, and that's progressive. You also have flat tax, which is essentially everybody's paying a fixed rate. And there are a lot of states that have flat taxes on income, or at least significantly flatter taxes than the progressive tax by the federal government. And then you have something called a regressive tax, which is the reverse of that. Essentially, you would tax lower income at higher rates than you do higher income. And there actually are regressive taxes within the federal tax system. And there are flat taxes as well. So benefits and burdens, this concept can kind of be used to argue a bunch of different ways. But the idea is, once again, getting back to the overall principle of fairness, we want the tax law to be fair so that all taxpayers are paying something that makes sense for under their circumstances. And this gives the tax law integrity and credibility. And it's important. If people, and it's worth going on a slight tangent here, it's important to know why do we care about integrity and credibility in our tax code? Well, we want compliance to be high. We want people to obey the law. If we're going to go through all the effort of passing laws, you want people to obey them. And if a tax law or any law lacks integrity or credibility and people don't trust that tax law or that law in general, then people might feel that they aren't required to comply with it. But we have very high compliance in our tax law in general, and maybe that's fear of the IRS more than some perceived integrity or credibility of the tax code. But at any rate, at a basic level, we want our tax code to be fair and credible. So there's a different argument apart from fairness now, and that's the efficiency argument. So once again, we're looking at kind of high-minded policy, ivory tower-ish ideas for formulating tax law. And to be fair, this does in fact drive tax policy in some ways, and it doesn't in others. In some ways, it's really driven by, because at the end of the day, Congress is writing the tax code, and the president is signing it, and so you might say that it's merely politicians that are writing the tax policy, but they do have to rely on some kind of underlying argument that makes sense. And so there needs to be a justification for what the politicians are putting into place, at least for highly salient taxes or highly visible taxes. And so they do tend to fall back on these concepts. So efficiency, this argues that the tax system should achieve tax revenues in a manner that maximizes efficiency and minimizes collection costs and changes to taxpayers' underlying economic activity. This is often referred to as deadweight loss. What's deadweight loss? Well, that's where taxpayers change their economic activity based off the taxes. So ideally, a tax system, if it were perfectly efficient, it wouldn't affect the taxpayers' underlying economic activities. Taxpayers would just go around engaging in economic activity that is, at its heart, the best economic activity to maximize profits or revenues or whatever it is the taxpayers seeking to achieve. And so we don't want to mess with those underlying activities. If we do, if taxpayers are actually changing their activities merely to avoid a tax, then that's typically considered deadweight loss. You're essentially changing the underlying economics of your tax base, and that's tax driven. And we don't really like that. It's an inefficient system. Additional concepts of inefficiencies are minimizing collection costs. Once again, you can have a very high tax rate and you can spend a lot of money trying to collect it. And that's typically not a good thing. A good tax system is efficient. And one of the issues that ties into efficiency is helping the general public, the taxed public, to understand what the tax code is. So if a tax code is extremely complicated and difficult to comply with, you have a certain amount of inefficiency in that. First of all, because taxpayers will fail to comply with it. It's confusing. It's difficult to understand. And so it's inefficient if it's overly complex in one way. Also, in addition to collection costs, you have compliance costs that can go up if you have a really complex tax system. So a lot of times efficiency will tie into complexity. I want to look at it from a different perspective though here. And that's when we look at efficiency, not just in regards to deadweight loss and making sure it's efficiently collected, but there's also a concept of efficiency that deals with maximizing the economic activity of the public. And another important topic within this concept of efficiency is that oftentimes Congress doesn't pass tax laws with efficiency in mind. In fact, sometimes tax laws are passed in order to encourage certain behaviors. In other words, Congress wants deadweight loss. They want the underlying economic activities to be changed. And in those instances, they might pass laws that are specifically with the hope that the tax will be inefficient, that it will change the underlying economic activity. And that some examples of that might be municipal bond interest savings. The goal is that by passing an exemption for interest or an exclusion for interest that is paid out on municipal bonds, then the government will encourage people to buy those bonds. And that, in fact, works, at least for individuals in the higher tax brackets where that benefit is more useful. And so to say that the government always wants the most efficient tax system isn't really accurate in reality. Sometimes Congress wants an inefficient tax system. Another example of that might be the sin taxes, and that's more at the state level, but sales taxes for things like tobacco and in some cases alcohol. So you might have instances where Congress is really hoping to deter the use of tobacco and generate revenues all at the same time, and so they might tax tobacco. And the goal is to, in fact, affect the underlying economic activity. So efficiency has its place, but it's not always, taxes aren't always passed in this pure petri dish, ivory tower-like manner. But these are different rubrics we can use to understand them. So now we get to optimal tax theory. So there are a number of different derivations of the idea of optimal tax theory. But generally speaking, the underlying idea is that there is a balance between maximizing utility through progressive tax rates and encouraging economic activity, resulting in a tax structure that optimizes tax revenues. So what did we just say by that? Well, think of it this way. If you buy into the marginal utility of the dollar and you're fully on board with that concept, and it's an appealing argument, I think, but if you buy into that, then you might say that we need a more progressive tax system. And so rather than having this scaled up tax system, maybe we should just say everybody makes over, and name your number, $250,000 a year or $1 million a year, whatever number you want to draw. We're going to have a 100% tax on that income. And so you make $250,000, 0% tax on all of that. And then once you get to $250,001, 100% tax. And so everybody, the most you can possibly earn in our society is $250,000 because everything's going to be taxed over that. Now you can see what would happen pretty quickly. Pretty much everybody would not seek out wages in excess of $250,000 because what would be the point? It's just going to be seized by the government. So granted, you might view that as a good thing, pays for the government, it's good, but at the end of the day, self-interest is going to prevent that from being an effective tax system. And I think there's been enough, I don't think there's really a disagreement on that. Another idea might be that you would tax everybody at 100% and then just have the government give back a certain amount, and that's basically communism. And I feel comfortable in saying that is not a very good way of optimizing the efficiency of your tax system. There are all kinds of bad incentives built into that system. And so the efficiency argument and the fairness argument tend to cut against each other sometimes. And in fact, if you went with a pure efficiency argument, I was talking about a pure fairness marginal utility argument where you basically tax everybody at 100% and give back equal amounts to everyone. If you went with a pure efficiency argument, it would actually go the opposite direction. So in that instance, you would probably tax the least efficient, at least economically efficient individuals at a really high rate. And why would we do that? So let's take somebody who's a multi-billionaire. Well, that person, particularly somebody who started out with nothing and built up a fortune into multi-billion dollars. Well, that person is clearly very good at playing the game of the economy and generating revenues. That is a person who's very efficient, at least economically speaking. And so in that case, we might actually not tax them at all, give them a 0% tax rate because we want more money to go to them so that they can grow the economy more, right? Or we might tax them at an extremely low rate, if not at zero. So that's kind of the optimal efficiency argument. So you essentially have the fairness argument and the efficiency argument pushing against each other. So if you wanted to optimize tax revenues, now the problem with the efficiency, if you didn't tax the high earners at all, is you wouldn't have nearly the tax revenues. So the optimal tax revenues are going to be somewhere in between those two extremes. On the one hand, you want to give a nod to the marginal utility of a dollar, but on the other hand, you don't want to deter people from earning that next dollar at whatever rate it's taxed at. So the optimal tax theory basically develops different tax rates at different income levels and says this is what we think the optimal tax rate is that will generate the maximum revenue. So this is the concept of optimal tax theory and how these various rubrics kind of interplay with one another. And so there have been several proposed changes to the income tax law, and these come up every year in politics, or every 2 years, I guess. You have midterm elections and presidential election years. And you typically get a lot of different proposals in these elections and in the campaigns of these elections. Whether any of them actually will take shape or not, that's certainly open for debate. But many of these taxes actually exist in our current system. And so it's worth looking at what these different taxes are. You've got a progressive tax rate applicable to income increases as income increases. The reverse of that would be a regressive tax. Then you have a flat tax where each taxpayer pays the same percentage on their income. Pretty straightforward. If you have a 10% flat tax, you earn $10,000, your tax is going to be $1,000. If you have a 10% tax, you earn $100,000, your tax is going to be $10,000. It's going to be 10% no matter what. That's the concept of a flat tax. Although most flat tax proponents typically have some sort of exemption built in of a certain amount of income, so it's not a true, pure flat tax, but it is what it is. Now, we do have a flat tax in our system, with a little bit of an exception, but the Medicare tax is essentially a flat tax. You're paying a certain small percent on your income. It's pretty flat. The net investment income tax and the additional Medicare tax kind of kick in to make it not quite perfectly flat, but for all intents and purposes, it's basically a flat tax. You're going to pay in a certain percentage of your income, of your wages at least, earned. And so we do have flat tax within our system. We also clearly have progressive tax because of the tax brackets for the federal income. Next, you have this concept of a head tax, and this is actually even worse than a flat tax, at least for low-income individuals. I shouldn't say even worse. Flat tax is fine. But a head tax is bad, I'm going to say. I feel comfortable saying that. Each taxpayer pays the same tax. So the idea behind this would be, okay, we need $3.5 trillion of revenue, and we have so many millions of people in our country, so we're going to divide the number of people in our country by the amount of revenues we need, and everybody's going to pay the exact same dollar amount of tax. And it sounds kind of crazy, but it's actually in the Constitution. The Constitution contemplated 3 different types of taxes, one of which was a capitation tax, and then capitation, of course, being a head tax. So it sounds kind of crazy, but the founders of our country, at least, had contemplated the idea and acknowledged that it was within the realm of possibility. Then you have a new concept too, and I shouldn't say head tax is a proposed change to the federal income tax. Nobody's actually proposing that, but there may be some fees that function that way. So next you've got value-added tax. And this is a tax on the value added to products in production. This taxes the incremental increases in value as raw materials work their way through the production process to become finished goods. Value-added tax, or a VAT, is something that's extremely common in Europe, and I believe most countries in the EU actually have a VAT, at least some form of it. If not exclusively, that is a part of their tax system. And so a VAT is something that has it's certainly gained a lot of popularity outside the United States, even though we haven't really gone to a VAT here in any meaningful way. Then there's the sales tax, and this is a federal level sales tax. It's the same concept as a state sales tax, and that idea gets bounced around. So it's worth comparing the difference between a value-added tax and a sales tax. Sales tax is essentially you're taxing the exchange between the producer, distributor, and the end user. So whenever you get to an end user, that's where the sales tax would affix. Whereas the value-added tax might be taxed along the way. You'd be taxing the same amount, at least theoretically, because at one point you sell raw materials, you tax on the increase or the extraction of those raw materials. Then at the next point, you're going to tax however you increase the value of those materials. And it's really, you take the amount you paid for the raw materials, back that out from the amount you sell the finished goods for, and that would be your VAT. You'd pay a VAT on that. And there may be many phases of that, but essentially you're getting at the same thing. You're taxing the increase in value on those materials. And so the sales tax is more of an end user tax that applies, but the idea is the same. You're taxing based on the value of products. So you could ask, how would these different tax systems change the tax burden on one, low income earners? That'd be somebody, by low income I mean somebody between $0 and $30,000 per year. Middle income earners are $40,000 to $90,000, and high income earners are somebody who earns $100,000 plus. Now you might argue whether that's really high income, but this is the numbers I'm throwing out here for purposes of my example. So progressive tax, clearly low income earners are going to come out ahead under progressive tax. The idea, and that's what we have at present. Somebody who earns $30,000, let's suppose this is maybe a couple that collectively are earning $30,000. Well, they're going to have standard deduction, they're going to have exemptions. Really, the first 20 and change of that is going to be taxed at 0%. And then the rest is going to be taxed at a pretty modest 10% rate, if any. And so you're probably looking at about $1,000 in taxes on that, assuming they don't itemize and they don't have any other tax benefits. And we're ignoring, of course, the earned income credit, which would certainly apply in that case. And so low-income earners, just under the basic rules of the tax and ignoring any credits, they're going to come out in really good shape under a progressive tax system. A flat tax system, if you simply applied maybe a 10 or a 20% tax to that, clearly they're going to come out worse off. They'll pay $6,000 in taxes, whereas before they'd only be paying $1,000. So a flat tax is going to generally disfavor low-income earners in comparison to a progressive tax. Next, you've got a head tax, which of course would be far worse as well. Rather than paying the 3, they would be paying the average of all of the taxes. So a flat tax would probably be more like $10,000 per person. So a married filing jointly couple paying a flat tax, paying a head tax, they'd probably be out about 20 grand. So they would take most of their earnings. And one of the things too is if they only earn 20, the head tax would take all of their earnings. The head tax doesn't really care how much you earn. It's not based off your earnings. It's based off whether you have a pulse. And of course, if you're only earning $20,000, you're being taxed $20,000, you probably won't have a pulse for very long because you won't be able to eat. So then you look at middle income earners. Value-added tax really quick and sales tax. So sales taxes generally are going to affect low income earners, at least theoretically more than high income earners. And the idea is that sales taxes on most of the things that low income earners are going to be buying are going to be subject to sales tax. And value-added tax would do a similar thing. Essentially, it would increase the cost of products, at least theoretically. And I think that's supported by the data. And so low-income earners, they wouldn't necessarily pay more in taxes directly, but if everything becomes more expensive for them, they would pay an indirect tax because there'd be inflation, price inflation, related to the tax that's being taken out. So even though they wouldn't necessarily pay it directly, the incidence of taxation would be hitting a low-income earner under a value-added tax. Now, high-income earners, value-added tax is somewhat neutral in the sense that if you're a high-income earner, you're earning a lot of income, but you're actually spending everything you earn, well, then you're feeling the value-added tax just as much as the low-income earner is. And maybe more if the low-income earner is spending less than they earn and actually saving money. So the benefit of value-added tax is that it encourages savings in that way. Because essentially the income that you earn that you don't spend, you don't have to pay any tax on. But I think it's pretty universally accepted that the higher income you have, the more disposable income you have, the more likely you are to save money, the less likely you are to pay a VAT. So the VAT's going to hit low income and middle income earners harder than it will hit high income earners in most circumstances. And that, of course, assumes that the high income earners aren't spending everything they earn, which they typically aren't. The data tends to support that. Okay, so that's kind of a view. Now, clearly, the progressive tax is harder on high income earners. They're taxed at a much higher rate on that higher income. So high income earners are typically not going to be very excited about progressive tax. Middle income earners, it depends on where the tax brackets work out. Generally speaking, most people end up with favorable tax rates under a progressive system. That's incident to the fact that we have a democracy and politicians can campaign based off changing tax rates for certain blocks of society that will benefit them. And they do. I think with Obama's election, particularly his first one, where he had campaign promises not to raise taxes on individuals that earn over $200,000, unless they earn over $200,000 or $250,000. And he tried to keep that promise, but failed to when the Supreme Court ruled that Obamacare was a tax. So now let's connect the dots between revenues and expenditures of the federal government. So we've talked a lot about the tax side now from a policy perspective. And I think it's helpful to also consider the revenue side, the expense side on the federal government's balance sheet or income statement at least. And so the idea is we're going to look at some numbers, and just to give some context on those, the federal fiscal year starts October 1st each year. And we have some deficit fun facts down here. So the fiscal year 2014 federal revenues and spending are as follows. The total revenues are $3 trillion, $21 billion, rounded off. Your total expenditures are typically $3.5 trillion for a deficit, at least in 2014, of about $483 billion. So some of the interesting facts about this is that federal spending exceeded revenues by approximately 17%. And this is down for 20% in 2013. And this was because of increased revenues. So total revenues back in 2013, the expenditures were about the same, pretty close to 3.5 trillion, but the revenues were more like 2.8 trillion. And so as the economy's recovered, the revenues have increased. And so the income statement looks a little bit better for the federal government. And it was worse again in 2012. And as you go back through the years, the deficit was much, much higher. So it's stabilized somewhat. And the federal debt's approximately 100% of the 2014 GDP. So your federal debt is around $17 trillion, and that's right about where your GDP is. So to put that in the context of an individual, that's basically saying you have more or less an unsecured liability of the amount of your income for the year. So if you earn $150,000 a year, that'd be like having a credit card debt. Well, credit card's kind of maybe an exaggeration, but that's like having some sort of debt in the amount of the full amount that you earn for the year. Now, of course, it's not entirely synonymous, but that's just one example. So there's your federal debt as of October 2014, $17,859,600,000,000. So there's our federal government's debt. So one way to look at this in terms of the spending, and I want to get down into the expenditures with a greater degree of detail. Now, sometimes when you get up in the trillions and billions of dollars, it's easy to just kind of lose focus or lose the ability to really conceptualize these numbers because they just seem so large. And so one of the ways that the Obama administration tried to help taxpayers understand that was with the idea of an income tax receipt. Now, there are some problems with this. First of all, the way they included expenses and the way they characterized expenses was not necessarily free from debate, I would say. In particular, the interest on the federal debt was not included in these numbers for some reason. And the way they characterized Medicare and Social Security tax, I don't necessarily agree with their methodology for how they did this. But I think the value in going through an income tax receipt is actually worthwhile in comparison to not just simply not knowing how our federal government's dollars are being spent. So I'm not, putting my stamp of approval on the income tax receipt that's published by the White House, but at the same time, I think it's helpful. I think it's a helpful tool. So we're going to go through this fairly quickly, but at least consider, and we have a little scenario here with Evander and Melinda Stevenson. They're married taxpayers who file a joint tax return and they paid exactly $10,000 in federal income taxes, $15,001 in Social Security tax, and $1,045 in Medicare tax. So we want to consider what percentage of this tax goes to the following government programs. So first, we've got national defense and veterans benefits. Well, out of $10,000 in taxes, about $2,984 would be going to that benefit. Once again, a little bit of an asterisk on these numbers, but I'll explain why after. So 29.84% of income from tax revenues is going to go to national defense and veterans benefits. Next, we've got foreign affairs, foreign aid, embassies, etc. And actually only $185 is going to go to that. 1.85% is spent on foreign affairs, at least on the balance sheet of the federal government, on the income statement of the federal government. Now we'll take a look at NASA. NASA pays about $66. That's about 0.66% of the total income tax revenues spent. Then you have welfare, which is at least under the income tax receipt proposed by the Obama administration or put forward. It's about $1,817 of the $10,000 in federal income taxes would be paid to that, or 18.17%. Next, you have health care. This includes Medicaid and unfunded Medicare. Now, the asterisk, a huge asterisk needs to go next to this because in addition to health care and Medicaid and Medicare, you also have an additional Medicare tax. So there are additional expenditures not included in here. These are not strict numbers based off the overall federal budget. This is essentially focused in a little bit on what the income tax revenues are going to. And there are, of course, other sources of funds for Medicare and CHIP programs and such, as a lot of these are funded by the states as well. So at any rate, with a huge asterisk, we say 26% of the federal budget goes to healthcare. Then you have the CDC and the FDA. About $91 would go to that, or 0.91%. So not a huge percentage goes to the FDA and the CDC. Then you have all other federal government expenditures, which we would have 2,202 or 22.02%. That's just everything else that the federal government spends money on. Now, once again, these percentages, I'm not really happy with them. And there are a couple of reasons, but once it gives you a little bit of an idea of where these things are going, it's worthwhile. But the asterisk that needs to go on all other federal government expenditures is the fact that we didn't include Social Security revenues, Social Security expenses. We didn't include Medicare tax. This was just the unfunded Medicare portion. So there's a lot more that's going to essentially retirement and healthcare benefits than shows up on this balance sheet. Also, some of the money in the healthcare and Medicaid funding is going to veterans benefits, not the classic benefits for veterans, but you have some healthcare funding that's also veterans benefits. And so categorically, if you put them in both places, you would add up to more than 100%, which is clearly a problem. But I just point that out, that you could easily push a lot of the veterans benefits down into healthcare. A couple other side notes. So the federal government, remember from the prior slide, the federal government actually spent $3.5 trillion in fiscal year 2014, and they collected $3 trillion in 2014. So we have these percentages adding up to 100%. And that's assuming that all the money that comes in is being spent essentially on whatever is on the federal government's expenditures as a whole. And the problem with that is that a lot of funds that come in are earmarked for specific purposes, Social Security being one of them. And so it's hard to really simplify this concept to this degree, but the idea is that the federal government, for every dollar you're giving to the federal government in taxes, the federal government's going on to spend anywhere from $1.20 to $1.50, depending on the year, whether we're in a recession, who's in power. And so it's spending more than we're paying. And that's a concept that would suggest that these percentage of income tax revenues going to these amounts should probably be reduced to add up to less than 100%. So the other thing is the White Hat numbers oversimplify by attributing most but not all expenditures to income tax revenues, oversimplifying the Social Security Medicare tax collections, and disregarding the significant outlays for interest on the federal debt. So once again, Not a perfect metric, and I've spent enough time beating it up, but it is helpful in getting a view of where the government spends its money. So I want to look at economic activity. Here we're going to move on now. We've kind of talked about tax policy. We've talked about how the federal government spends its money. Hopefully that was educational, and I know that was kind of fluffy and ivory tower-esque, but it still is a helpful concept to know and to understand. So I want to move on and talk about the tax reporting and collection process. So this is where we're getting more into the day-to-day activities of your average tax preparer and what you're dealing with as a tax professional or potential tax professional. And so in terms of economic activity, a taxpayer engages in economic activity each tax year that gives rise to reporting requirements and tax obligations. So from a tax professional's standpoint or a potential accountant or C.P.A. standpoint, on the one hand, this is just what the taxpayers are going to do. And if you pick up a taxpayer as a new client, usually you're going to pick them up at the point where you're doing their tax return. That's just commonly where they're going to seek you out, and you'll pick up clients then. You also may pick up clients when they want to do tax planning. Now, tax planning is essentially them telling you, look, I want to plan my economic activities in a way that is going to be favorable for tax purposes. If all things being equal, I can do something one way and get one tax result, do something in another way and get another that's better. I want to do the more favorable activity. Now, of course, all things are rarely equal, but nonetheless, oftentimes taxpayers will seek out tax professionals to do tax planning. So there really is a role, a potential role, and a significant role for tax professionals at the economic activity level. And hopefully you have a relationship with your clients where you'll be able to engage in discussing the economic activities and how they translate into tax consequences. Next, you have filing a tax return, right? That's just classic. After your tax year's over, you file your tax return. This will be on April 15th. If you extend, it'll be later. If you're a corporation, it'll be earlier. You have all your tax deadlines, March 15th, April 15th, September 15th, October 15th. This is not unfamiliar to you if you're in the tax world. But one thing to discuss is that the U.S. has a voluntary tax compliance system, which means the individuals voluntarily report their tax liability by filing a return to the IRS. It, of course, does not mean that the obligation to pay taxes is left to the discretion of the taxpayer. You have to pay your taxes. If you don't, the IRS comes and does a whole bunch of nasty things to you, garnishes wages, levies your property, all sorts of things. Also, it's not entirely voluntary in the sense that there is some involuntary, I don't know if involuntary is the right word, but there's some forced engagement in the tax system before April 15th. And that's in the matter of withholdings. For corporate entities, they have to pay their taxes along the way with quarterly payments, or for individuals who are business owners, they also have estimated payments. So there's certain requirements along the way before you actually just get to filing a tax return in terms of engaging in the tax system, of course. But the general system is a voluntary system. So that's what we use. Individuals have filing deadlines, as I mentioned before. And filing a tax return is an admission by the taxpayer that the tax stated on the return is owed to the IRS. Although if an error is made in calculating the tax, then the taxpayer may file an amended return with the applicable statute of limitations window. If the taxpayer fails to file a return, the code permits the IRS to file a return on behalf of the taxpayer for purposes of an audit. And this is not usually a very good thing to have happen to your client. If they fail to file their return and a tax return is filed on their behalf by the IRS is going to do a very vanilla return with the most basic exemptions and credits if it's an individual. And really, you're not going to be in a very favorable tax position if you let the IRS file your return for you. And if they're doing this, it's because you failed to file a return. Your client failed to file a return. The IRS doesn't want to be in the business of digging up all the ways that your client could have paid lower taxes by reporting deductions and credits and exemptions and exclusions. And so by and large, this is not going to be a very favorable result. So it gives an added incentive to file your tax return on time. Of course, the IRS won't do this until usually for a period of years goes by without filing a tax return. So beyond filing a tax return, you have what are called examinations and litigation. So the IRS may examine a taxpayer's tax year and assess additional tax, interest, and penalties, so long as the tax year is within the applicable statute of limitations window. If the taxpayer disagrees with the IRS, the taxpayer may file an administrative appeal within the IRS or file tax litigation. So an IRS examination, that's really an IRS audit. So to most individuals, we call it an audit, a tax audit. That's what your average taxpayer will call it. And that's what a lot of tax professionals will call it. It's an IRS audit. But internally within the IRS, they'll refer to it as an examination. It's like an awful examination, but it's an examination nonetheless. And then tax litigation is following that. Within the examination process, you can file what's called an administrative appeal. And a lot of times that gives you an opportunity to elevate a concern up beyond the immediate examination that's in place and get past the auditor that you're dealing with and have a somewhat, well, at least theoretically neutral third party to review it within the IRS. And then outside of that, you're stuck in litigation. Once the amount of the tax has been finally determined, and whether that's at the point where you file your return and say, hey, I owe this money, but I didn't pay it, or at the examination point, or if you litigate at the conclusion of litigation, really, at some point, there's going to be a final settlement as to the amount that's owed. And once that's determined, or at least as that's being determined, collection proceedings may begin. So once a deficiency is properly established, the IRS has authority to engage in a number of aggressive collection proceedings, including garnishing wages, placing liens on the taxpayer's property, and even seizing and selling the property of the taxpayer to satisfy the deficiency. So there are a number of things the IRS can do. This is all tying in with the administration of tax policy. So the IRS, of course, just as a background matter, the federal agency within the Department of the Treasury that is tasked with the administration of the federal tax code. Nothing too earth-shattering there, except that just to give you an example, I knew one of my friends was working at the IRS as an agent, an attorney, and whenever people would ask him what he did, he would always say he works within the Department of the Treasury because he didn't want people to know he worked for the IRS. So IRS examinations, as discussed before, the IRS audits taxpayers, which is referred to internally as an examination. The IRS assesses deficiencies where there's a failure to pay the tax and the IRS believes should have been paid, and the IRS litigates deficiency disputes. And this is all within the civil arm of the IRS. There's also a criminal division of the IRS, and this is a segment within the IRS that works with the Department of Justice on criminal tax evasion cases. And really the goal of that is to do investigations and refer any matters that are potentially criminal out to the Department of Justice. Now, typically, they use a lot of materiality provisions here. So a mere understatement of tax is not automatically going to push you out into criminal division. There are kind of two things that are really driving the pushing, moving the needle, if you will, on the criminal division. One is they'll look at materiality. Even if somebody basically was fraudulent in misreporting their income, typically it's not going to get pushed out to the criminal division unless this was substantial. There was a substantial understatement. And that can vary, but my experience has been that it's not going to go out to the criminal division unless you start to get into the hundreds of thousands of dollars. I'm not saying that's some kind of bright line rule. That's just been my experience. And so, take it for what it's worth. So materiality is kind of an issue as to whether they refer it out to the criminal division. So that's one aspect. The other is intent. Now, with criminal, the IRS is concerned with what was going on within the mind and heart of the taxpayer at the time when the tax liability was understated. And it's called, in legal parlance, it's called mens rea, which is you had a guilty mind. And so if you had a guilty mind, you essentially didn't care about the result. Well, how would I say this? You had a guilty mind, meaning you did something intentionally, either intentionally or so negligently that it's almost reckless or even reckless. And so that's the concept of a guilty mind, right? You did something culpable, you did something bad. And so you need to have that. If a taxpayer was just wholly ignorant to the tax code and significantly understand their liability, and they made an honest mistake, but an honest mistake that was a big mistake, they may meet the materiality to where they would consider sending it to criminal. But if it really was an honest mistake that they didn't know that they were messing up their taxes, then you may have a hard time getting that over to criminal. And you can understand that's a slippery slope in a way, where you could say, well, I didn't know, I had no idea, oh my goodness, this was just a surprise. So the IRS will use its judgment in what it refers out. But there again, it's kind of the substantiality, the materiality requirement tends to drive the ship a lot in terms of whether it gets referred to criminal. Additionally, if a taxpayer is particularly vindictive against the IRS, or if the IRS feels like they need to be made an example out of, you might get some political reasons why something can get driven to the criminal division. And I don't mean political like conservative Tea Party type political. I mean more in terms of the IRS trying to deter certain behavior that they deem to be a problem. And so if there's a specific tax position that's become problematic for the IRS, they want to deter it, they feel like it's made in bad faith, then even lesser amounts could get referred to the criminal division, essentially because that will make an example of that taxpayer. Probably shouldn't happen. I don't know it's the fairest thing when that does happen, but it certainly does happen, and I've seen it with clients. IRS guidance. So the IRS does not actually write the tax law generally, but it does provide guidance to taxpayer on proper interpretation of the tax code. And this guidance takes several forms. And the first form, of course, is publishing tax regulations. Now, this is the strongest argument for saying that the IRS does in fact write the tax code, because tax regulations are basically the tax code. Let's be honest. I mean, they're interpreted with great deference, and tax courts in general are going to look at those and give a lot of credit to the IRS's opinion when it's a published tax regulation. Additionally, the IRS will publish tax forms and instructions for filing tax returns. These are given less deference than tax regs, but still are given a fair amount of deference. Once again, the forms, you don't get a lot of challenging in the forms, but sometimes forms are wrong, that mistakes are made. Then as we go down this list, we're reducing the level of authority on these. And then you've got publishing official guidance in the form of internal revenue bulletins. And these are somewhat more official documents, but not quite as official as tax regs. Then you have the issuance of private letter rulings to individual taxpayers upon request. And last, you have publishing guidance in the form of various publications and posts to its website and other publications by the IRS. So these are really in order of priority, more or less. So a private letter ruling has significant authority to the individual who it's issued to, but it may not have a substantial degree of authority in a general sense. So a PLR is not binding authority to other parties, non-parties to the PLR. But it does give an idea of which way the IRS may go on a particular issue. And so I don't want to say they're irrelevant. You just can't rely on a PLR and say, okay, I know my tax position is valid because this PLR says it is. That's not going to hold up in court. You need to prove it based off the underlying regs and code and official guidance by the IRS rather than using a PLR. Okay, so now we want to think a little bit about the audit process and how the tax laws are administered. And the audit process is kind of interesting in the sense that only about 1% of tax returns are subjected to an IRS examination or audit. So the IRS uses a number of factors for determining which return should be subject to an audit in order to maximize collections. There are also varying types of audits, including a correspondence audit, a field audit, and an office audit. They all have different ways of achieving an audit by the IRS. Correspondence audit is pretty straightforward. They're just going to send letters to your client, request information. Your client will respond, hopefully, provide information so that they can substantiate any deductions or explain why any income may not have been claimed and just provide data to the IRS through correspondence, through letters. A field audit is where the IRS will actually go out, meet with your client, interview them in person. And then there's an office audit where the IRS will call your client into the IRS office and essentially perform the same type of interview they might do in a field audit, except without the benefit of seeing the operations of the taxpayer. The taxpayer's tax liability can be settled by agreement between the taxpayer and the IRS at any point during the audit and collection process. And so if an audit is underway and the IRS issues a no change audit, then they're essentially agreeing that there's no change, where they can issue a different type of audit and assess a deficiency, issue a 30-day letter and a 90-day notice of deficiency. So there are a bunch of different outcomes that may result from an audit. And the taxpayer can reach out to the IRS and indicate a desire to settle at any point, and that can be done. So there are statute of limitations, however, on the IRS's ability to collect and assess tax. The statute of limitations are a legal concept where certain claims are barred after the passage of a specific period of time. And this is really just an overall concept of fairness. You can imagine a scenario where two parties have a disagreement. Maybe one party harms another physically, car accident or something like that. Or alternatively, you can imagine a contract dispute where some party's wronged, and so the wronged party wants to seek a judicial remedy and go to court. And the statute of limitations stand in the way of filing these actions, particularly in civil suits, but this also can apply in criminal suits. And filing an action really, really late after the event occurred. You can imagine 50 years passing and somebody filing an action for some wrong from 50 years ago. And imagine all of the difficulty somebody trying to file such a claim would have and somebody trying to defend such a claim would have. There are a lot of problems. Documents get lost. People's memories change over time. People die. People are less reliable as time passes in terms of their memories. So statute of limitations are in place so that litigants will bring their claims in a prompt manner, will bring their claims soon to the court, so that the court isn't dealing with stale claims where the evidence is no longer around, and the idea is that the results will be better. And the result of the litigation will be better if the litigation happens closer to the time when the events which brought rise to the claim occurred. So that's the underlying concept of a statute of limitations. In the tax code, there is a statute of limitations. There's a 3-year general statute of limitations in the Internal Revenue Code. And this is the general statute that applies in most cases. This is 3 years for the IRS to assess additional tax. And the statute starts running, meaning this 3-year period begins to run, on the later date of when the taxpayer files a return or the date the return is due. So if the taxpayer files a return after the due date, it starts running whenever the return is filed. If the taxpayer files a return before the due date, the statute of limitations begins running on the due date. Now, before the due date, it's not a big deal because essentially you typically have 2 or 3 months there where you may file your return. You're not going to file your tax return before the end of the year, and usually you don't have all the information to even file it within the first month. And so if it's an individual taxpayer, for instance, they may file it as early as February, but you're only talking about a couple of months difference between then and the due date. But when it's filed after the due date, which is clearly very common with extensions, then in that case, the statute of limitations will run from when the return's filed. There is an alternative statute of limitations. There's actually 2 alternative ones, but the first one is for understatements of tax of 25% or more. So the 25% applies to the understatement of the taxpayer's gross income. And so understatements, there is some limitation to that concept. It's not necessarily just the tax is 25% understated. It's more that the gross income is 25% understated, either by virtue of an overstated deduction or an understatement of gross income. So the statute of limitations on assessments in such understatements is increased to 6 years rather than just the usual 3. And if the taxpayer files a fraudulent return, or does not file a return, there is no statute of limitations. And so if you commit fraud in filing a return, or a taxpayer does, then the statute of limitations never runs. So even if you're outside the 6-year window, you can have an assessment by the IRS as long as it's based on fraud. Next, you have refunds. Refund claims may be filed within the later of 3 years from the date the return was filed or 2 years from the date the tax was paid. And so refund claims, this is the idea where you file your return, pay the tax due on the return, maybe even have an assessment from the IRS where they claim that you owe more and you pay that as well. But then you want a refund. You think that it was improperly assessed for whatever reason. So you file a refund claim to get your money back. And the reason you might do that and pay, there are a number of reasons, but you may want to avoid the accrual of interest and penalties just in case you're wrong, in which case you may pay the tax and then file a refund claim. So different statute of limitations applies there. Next, we're going to look at some of the sources of tax authorities. And the reason we care about tax authority sources, there are several different ones, and we care about the level of authority that they raise. There's two ways this comes up. One is for paid preparer penalties. It's important to understand the degrees of authority and the sources of authority and which authority has greater weight in order to determine whether a paid preparer penalty may apply for an aggressive tax position. Alternatively, just in terms of understanding what taxes do and what the law is on tax, the more you practice in tax, the more you understand that there are a lot of gray areas and there are a lot of laws that are potentially conflicting, and sometimes it's not entirely clear what the proper tax position is. And so, especially in these areas, it's important to understand what authority is out there and understand what authority is more authoritative. So there are different sources of tax authority, and short of authoritative sources, there are many outlets for understanding the tax law. I'm just referring to them as outlets for understanding because those are not necessarily authority, not binding, but there are ways of helping yourself to understand a particular tax concept that you can't cite as authority in court, but would help you understand it preliminarily. Sources of tax authority are indications of the tax law that are binding in a tax proceeding, while other outlets of tax information may be helpful in learning the tax law. When doing tax research, it's absolutely critical to understand the difference between these two. So primary authority is the only real relevant authority for purposes of tax litigation, and really when you're under audit and such, the primary authority is what you should be relying on most heavily for your positions, for arguing your positions. If you rely on non-primary authority that contradicts primary authority and it results in an understatement of tax and a reasonable tax preparer would not have made this mistake, then you've committed malpractice. So that's, of course, malpractice is a state-by-state concept, and there are varying standards for that, but as a general rule, most malpractice lawsuits are based on instances where a tax preparer diverges from how a reasonable tax preparer would have acted. And so you're really in trouble if there's primary authority out there that contradicts your position, and you relied on non-primary authority. So primary authority, we're going to go in order of priority here. And you have first primary authority, then you have pseudo-official sources of tax authority and unofficial sources of tax authority. So primary authority, you're going to start with the U.S. Constitution. Not a whole lot in there, frankly, but there is some tax law in the Constitution. And really, the Constitution is going to function as a limiting factor that says, here's the outside parameters within which Congress can function, and Congress can initiate and write tax laws, and the IRS as well, in the sense of regs. And so the Constitution is really just drawing the outside limits of what Congress's authority is. It's not something that's going to be highly relevant in a tax practice. If your position is that your client does not have to pay the tax because the tax is unconstitutional, you're probably in serious trouble. Once in a while you might be right, but that's not a tax position you typically want to take. The next is the tax code and tax treaties. And the tax code, clearly the IRC passed by the Congress, signed into law by President. That's just federal code. Pretty straightforward there. Tax treaties, on the other hand, can be a little more complicated. You have tax treaties negotiated between different countries, and if you're dealing with an international tax issue, particularly companies that are international and activities between domestic and international parties, then tax treaties may come into play. And particularly, the issue with tax treaties is oftentimes deciding where the source of the income is and which jurisdiction gets to tax it, if any. And so, certainly beyond the scope of this course, but it's something that's certainly important, and it's authoritative just below the Constitution, similar to the tax code. Next, you have regulations, and regulations are written by the Treasury Department. Oftentimes, you have varying degrees of authority within the regulations. Legislative regulations are typically the highest authority. That's where the tax code specifically designates that the Treasury should write a particular regulation. And those types of regulations have very high authority. Then you have other regulations executed under the Treasury's general grant of authority to write regulations, and those also have high levels of authority. Then you have procedural regs, which are less so. You also have proposed and temporary regulations, which haven't been through the full vetting process that other regulations have gone through. They'll be less authoritative, but still important to know. Some proposed regulations that aren't ever made final will expire. Proposed and temporary regulations can expire with time. And so if you see a proposed or a temporary regulation and that was never made final, and 2 or 3 years have passed or longer, then you might need to use care in relying on that regulation. Official IRS guidance is the next primary tax authority level. This is revenue rulings and rev procedures. So this is the official guidance by the IRS, not quite as official as regulations, but still important and something that you can rely on to the extent it does not, and really, and this is the case with all these, you can rely on these to the extent that they don't contradict a higher level of authority. So this is in an order of priority on this list. Next, you have case law. And it's important to note with case law, the level of authority for a case law is going to vary depending on what the case is interpreting. So if the case is interpreting a constitution, then the case law is going to have basically a level of authority just below the Constitution. So it could be overridden, but case law interpreting the U.S. Constitution and tax law is going to have very, very high authority. Now, alternatively, case law might be interpreting official IRS guidance in comparison to the tax code. In that case, it's going to have the level of authority of official IRS guidance, and it can be overruled. And the tax code, for instance, a case might interpret the tax code. Well, Congress can change the tax code, and then the case will be changed as well. So the case is basically going to attach to whatever authority it's interpreting in terms of its level of authority. Then you have private letter rulings, determination letters, and these are only for the taxpayer requesting the ruling, not binding elsewhere. Then you have these, what I call pseudo-official sources of tax authority. They're not official, they're not primary tax authority. You can't necessarily even rely on them in court necessarily, but these are tax authorities that do carry some weight, generally speaking. You have unofficial IRS guidance, private letter rulings to the taxpayer the ruling was not issued to, the IRS handbook, and congressional committee reports on statutes. So these are things that courts will look at and consider when trying to interpret the tax code, but they're not primary authority. The courts aren't going to be bound by these things. Really, they'll look to these types of things in the absence of other guidance, and the level of deference a court is going to give to these things, these pseudo-official sources, is going to vary greatly. And once again, courts know they are not bound by these, and they won't follow them unless they want to. And so that's why I call them pseudo-official sources of tax authority. Lastly, you've got unofficial sources of tax authority, and that's basically everything else. Things that are written on the IRS's website are included in there. And basically anything else that's written about tax law, any tax textbook, any tax online service, any publication in tax, all of those are in unofficial sources of tax authority, and none of them have any real authority under the tax code. So with the U.S. Constitution grants Congress to have power to lay and collect taxes, duties, imposts, and excises to pay the debts and provide for the common defense and general welfare of the United States. But all duties, imposts, and excises shall be uniform throughout the United States. The 16th Amendment granted the Congress the power to lay and collect taxes on incomes from whatever source derived without apportionment among the several states, which was previously required, and without regard to any census or enumeration. So the Constitution, again, functions as the outside limit of the taxing authority of Congress, but does not require that taxes be levied. Then you have the tax code, and the tax code is a federal law that is passed by the legislative arm of the federal government, or the Congress, which passes the bill and is signed into law the president. Or alternatively, the federal code can also be passed by a 2/3 majority of Congress without the president's signature. Tax code is the primary source of tax law and is trumped only by the U.S. Constitution, meaning if the law goes beyond the authority granted in the U.S. Constitution, then it will be deemed unconstitutional. In-depth tax research should generally start with identifying the specific relevant tax code section and then proceeding to lower levels of authority for further guidance, although lower levels of authority are almost always used to identify the relevant code sections. And what I mean by that is you might start with just a publication that you find online in regards to a particular tax situation, and that will educate you a little bit on how the tax code is interpreted, and more importantly, it'll hopefully give you citations to the actual code, so you can go to the code and work your way back through. So there are a number of ways. You have the internal tax, the Internal Revenue Code is organized in chapters and subchapters. Subchapter K deals with partnerships. You'll hear that word used a lot. Subchapter C deals with seal corporations. Subchapter S deals with S corporations. Some of the other subchapters people don't really call some people don't really call things by subchapters necessarily, but there are a lot of different subchapters that people go by. Tax practitioners will go by. So then we look at tax regulations. IRC Section 7805A entrusts the Treasury or the IRS with the duty to issue rules and regulations to explain and interpret the tax code. This is the general grant of authority that the IRS has. Tax regulations, which are technically called Treasury regulations, are published by the Treasury and the IRS and are subject to a comment and notice period. There's a very high degree of deference given by courts to regulations, but if it can be shown that the regulation is not consistent with the tax code, then the regulations can be overruled. And the idea of giving deference to these regs is that essentially if the court determines that a particular code is ambiguous as to a particular concept, then a lot of deference is going to be given to the Treasury regs, and the court's going to follow the regs in most cases. This is called a Chevron analysis, where you essentially go through different steps to analyze whether an administrative agency's interpretation of the law is valid. As mentioned before, there are different types of tax regs, and they have varying degrees of deference that are given to each of them by the courts, although most regulations are given substantial deference. You have legislative regs, interpretive regs, and procedural regulations, and with varying degrees of deference. Legislative get the highest, interpretive are next, and then procedural regs. Temporary regs may be cited as precedent and are found in the Federal Register, Internal Revenue Bulletin, and Cumulative Bulletin, and they're also concurrently issued as proposed regulations in order to become final regs, and they automatically expire within 3 years after the date of issuance if they do not become a final reg. So some of the trial courts relevant to tax issues include the U.S. Court of Federal Claims. The Court of Federal Claims hears tax and other monetary claims against the federal government. This court formerly was called the U.S. Claims Court. And there's only one U.S. Court of Federal Claims. The court meets most often in Washington, D.C., and decisions are appealed to the U.S. Court of Appeals. Then you have the U.S. Tax Court. Now, this is a huge player. Taxpayer does not pay the deficiency before trial, so you have deficiency jurisdiction, which is a good thing for taxpayers. Decisions are appealed to the U.S. Court of Appeals, and memorandum decisions may be used for precedent, but unpublished opinions may not. So if you're looking at tax court opinions for guidance, you want to make sure that the court opinion's published. Unpublished opinions can be helpful, at least in knowing what the tax court's done in the past, but it's not going to be binding precedent. Small cases division of the U.S. Tax Court hears only tax cases, and the dispute needs to be $50,000 or less. There's no appeal available, and opinions are not published. Next, you have U.S. District Courts, and these are just general federal district courts. They hear tax as well as non-tax cases. And this is the only court where a jury trial is going to be available to the taxpayer. The decisions are appealed to U.S. Court of Appeals in the regional circuit, meaning the circuit for the region in which the taxpayer resides. And then you have the appellate courts. There are 11 different circuit courts of appeal. These courts hear appeals from all of the lower courts and opinions. It's like the 5th Circuit, the 10th Circuit, the 9th Circuit. You have all these different circuit courts of appeals, and these are the appellate courts. It should be noted that the circuit courts may disagree on the same issue, in which case the court the taxpayer resides in becomes really important to knowing the applicable tax law. So if you have a split among the circuits, it depends on which circuit the taxpayer resides in. So I have a little problem here. It just helps us illustrate what the sources of authority are and what the value is given to each different source of authority. So we want to look at this and rank our sources of authority. So I gave a number of different items, all dealing with a similar concept, tax concept. So in this case, we want to look at how would we rank these sources of authority. So assuming some of these authorities disagree with one another, how would we rank them? And you could go through and work through this on your own. The links are provided, but you have in this case, we're going to start out. Clearly, the top law of the land is going to be the U.S. Constitution. So number 1 is going to be the U.S. Constitution. That's the top authority. There's no question there. The next issue is going to be, well, where do you go from there? What would be the next source? Well, and that's going to depend. So courts, as we know, can have a really high level of authority if it's interpreting the Constitution. So here we have Gates versus Commissioner 135 Tax Court. I didn't give you the full site there, but there's a link to it. So with Gates versus Commissioner, that could be as high as the U.S. Tax Court, or it could be as low as some unofficial source of authority, depending on what it's interpreting. Is it interpreting something that the IRS put on its webpage? Is it interpreting the Internal Revenue Code? What is that case interpreting? So you really could start at 1 and go all the way down. It's not going to be probably unofficial publication level, because why would a court be interpreting some unofficial publication? That's just not something that would happen in a tax case. So it's going to be interpreting official precedent-setting sources of authority. So you're going to start at 1, potentially 1 for Gates versus Commissioner, and we'll go down and we'll see how low we get before we get to the unofficial sources. So number 2 is going to be your tax code. And if we had treaties up here, that would be number 2 as well. So 26 U.S.C. Section 121, that's IRC Section 121. Anytime you see 26 U.S.C., that's the same thing as the Internal Revenue Code. So that's going to be your number 2. Number 3 in this group is going to be your regs, up towards the top. Treasury Reg Section 1.121-1. You can see that's typically that number that's after the dash is typically going to be the Internal Revenue Code section that it's interpreting. So that's going to be interpreting IRC Section 121. So that's going to be number 3. Number 4 will be your Rev Proc. Once again, official guidance by the IRS, not as authoritative as a treasury reg, but still official guidance. And then you've got IRS Publication 523, which is going to be number 5, as well as IRS Topic 701. Those two concepts are not official guidance per se from the IRS, but they are going to be somewhat authoritative as unofficial. And then you get, lastly, you've got the Journal of Accountancy, which will be number 6, and Southwestern, which will be number 6. Those two things are just not primary source of authority. They have no weight whatsoever. And the Gates versus Commissioner, it's going to be 1 through 5, somewhere in there. In this case, I believe it's actually interpreting the Internal Revenue Code, so that's probably going to be a number 2, if we were being precise. But the point is, cases in general could be anywhere from level 1 to a level 5 on this rubric. So why do different sources from the IRS have different levels of authority? Well, as we've discussed before, Treasury regulations go through a comment and notice period. They're given a lot of deference by the courts based on that. On the other hand, something that the IRS throws up on their website, just as a quick explanation, that's that's not going to go through the same degree of scrutiny before it becomes published, and as such, it's not going to have the same weight. And it also they aren't directed by Congress to write those things. So now we're just going to wrap up this course looking at tax research methods. So here's a question of how to do tax research, and this is applicable in the administration of tax law. And we can apply all these concepts of different weights of authorities in doing tax research. So let's look at this process. So the first step of tax research is identifying and refining the problem. You want to develop search terms and understand what the issue is you're looking at with your taxpayer. So a lot of times you can Google different issues and you'll find some interesting publications that'll help educate you on a specific tax issue. And that's not a bad way when you're at the identifying or refining the problem step. You don't want to rely on Google later on where you're trying to understand exactly what the tax law sources say. Googling is just about getting to know what the issues may be. It's not about, you don't want to rely on Google wholly for all of your tax research. So the next step is to locate tax law sources that are on topic. And you can use Google to do this in the sense that if you find an article online that's from a reputable publisher, oftentimes they'll have citations to everything they say in the article. Now you want to find those sources of authority that are in those citations. You want to find what is there in the Internal Revenue Code that specifically addresses this issue. And if there's nothing specific in the IRC, you want to look at the regs. If there's nothing specific in the regs, you're going to look to IRS publications, official IRS publications. You might also look at tax court cases. Probably before you get to IRS publications, you want to look at cases as well. And they may apply, once again, to any of these different things, different sources of authority. But you want to locate the law sources on the topic, the tax law sources on this topic. And it's important to do that. That's an important step. And this is really what's going to differentiate between finding something online and relying on it, and finding something online, doing the underlying tax research, and making that knowledge your own. And you're going to do that when you look at the underlying sources of authority and evaluate them. Then you're going to assess the validity of the tax law sources. And that's just prioritizing. Whichever ones are higher priority are going to take precedent generally. Now you need to be careful because you need to make sure that they deal with the same topic. For instance, you might have a tax code section that covers a topic very generally, and then below it you'll have a regulation that goes into more specifics. Even though the regulation may, at least on its face, appear to potentially contradict the tax code section, it may be providing a greater degree of specificity, which is appropriate. And so, again, you want to, when you're looking at the different levels of authority, you want to make sure that they're not speaking to the exact same issue. If they're speaking to the exact same issue, go with the highest level of authority. And arriving at the solution or in an alternative solutions with due consideration given to non-tax factors. So that's the last step. You're going to apply all this authority that you've found and come to a solution or an alternative solution, taking the non-tax factors into account. So it may be a business deal, and you need to understand the business terms of the deal before you can apply the tax law sources and make a recommendation. There may be non-tax factors that are more important than the tax factors, so you need to keep those all in mind and communicate with your client. So this is pretty much, we've got a research project, and this is just a sample if you want to take a look at this. And you get something, it's the ambiguous client tax email. And this happens all the time in a tax practice where you get some email from a client asking for tax advice. You may get a phone call as well. And the client says, hey, I'm doing a tax-free exchange and I wanted to get some cash out either just prior to or after the refinancing. And I was wondering if that causes any tax issues. The broker thought I couldn't do it that way, but he said I had to talk to my tax expert on that. Anyway, I've got to give them a decision today, so if you can just let me know, I'd appreciate it. Thanks, your beloved rich tax client. So these are the types of emails you'll get all the time, and this is an invitation to do some tax research. Now, you may be familiar with tax-free exchanges, and so you may already know this, but this is a good little example of how you can do some research on this concept using Google. You also may use some of the tax research sources that are a little bit more reliable, like IRA, CCH, Thomson Reuters, is, I believe, took over the IRA checkpoint. But these different sources of authority, these different services are sometimes helpful in doing these tax research, and they can advance you along your way a lot better than Google can, because they'll typically be annotated and take you right to the primary tax authority that you need to rely on. So this is just a little problem to show you something you could use. And applying our tax research steps, we'd start out by identifying and refining the problem and developing search terms. So tax-free exchange might be some of the search terms. We might look at liabilities, refinancing. These are different search terms we might plug into a Google search or a search within a tax research database. Then we want to locate tax sources on the topic. So through that step of using Google or whatever else we're going to use to search, do our research, we want to locate the tax sources and find citations to sources of authority whenever we see positions stated in regards to the tax. And then assess the validity of the various sources and arrive at a solution and provide an answer to our client. So that wraps up our class for today.